The Federal Reserve may need to step it up, with the next round of trillions in stimulus from the government delayed until further notice. The economy will desperately need a boost since it can't do so on its own. And what's the best way to boost a very sick and weak economy? By buying bonds of companies like Apple, of course. Wait a minute, what? You came here for the truth, so let me unveil that for you. Today we're going to talk about what's happening with the central banks. I'm going to show you what's happening with the markets. I've got some indicators to show you, to give you updates on. What we are seeing right now in the economy is that it's sick, it's weak. And what does the Federal Reserve do? They buy bonds of companies like Apple. Come on, are you really serious here? That you need to buy bonds of the biggest company in the world? That you need to buy bonds of all these other companies? And instead, what's happening is you're actually really hurting the average person because you're devaluing the currency during this period. And they don't want to admit that. They never do. They don't say that, okay, by printing money here, we're actually going to be hurting the average person. And guys like me, Jerome Powell, are going to benefit because we're multimillionaires and this is the way it works. It is such a fraud. It's such a scam. But people are just asking, please, please, more. Print more, do more, loan out this, loan out that, create these new programs, skirt around the actual rules and regulations. And I have to see all of this nonsense that the Federal Reserve has been taken over by the government, and now it's under the control of this government, and there's no need to worry anymore. It is just completely haywire. What's been happening is all upside down. Look, we need to understand that the central banks are the head of the snake, particularly the Federal Reserve, and the actions that they take are not in your benefit. Okay, so here in this video, I've got a lot to get into, so no more ranting. Let's begin. On November 5th, the Federal Reserve had another meeting. What was discussed? Same old, same old. It is status quo, 0% on the interest rates as expected. They haven't done anything with that. And then we have essentially the same QE, just promising that they will continue to do so at this rate. They will expand their balance sheet. That's what they said. Nothing here had really changed, nothing concrete at all. They really wanted to just acknowledge the fact that they are willing to go above and beyond this 2% inflation target. Don't worry about it. We're going to allow it more flexibility and this and that. Nothing new at all. And I just wanted to bring that to you, as well as the fact that the balance sheet sits around $7 trillion. I just checked it. The newest update showed that it went down just slightly, but the trend is in. It's basically kind of one of these here. And that's it. Just a quick update. Let's move on to this. This Bloomberg article was written by the former Fed president, Bill Dudley, and he had some really good things to say. And I wanted to bring it to you. I actually couldn't believe it, but it's here. So let's take a look. The stimulus provided by lower interest rates inevitably wears off. Cutting interest rates boosts the economy by bringing future activity into the present. Easy money, and this is him saying this, easy money encourages people to buy houses and appliances now rather than later. But when the future arrives, that activity is missing. And I just want to highlight that once more here. The actual activity that is happening, people are buying stuff today. They're pushed into it because of, as he says, cheap money. It's easy to get that credit. It's easy to find ways to spend more money today. So they do. But instead, they are robbing from the future. That means next year they might have a problem. 2 years, 5 years, whatever the case may be. Spend now, get the economy going now. Don't get it going next year. We'll worry about next year when it comes. And this short-term thinking is always very bad. That's why when you have a crash, it isn't necessarily, just like one of these soft landings and so on. It's so exaggerated today, and they don't want to admit this, but of course, this is what we deal with. The only way to keep things going is to lower interest rates further, which is what they did last time around. Until that is, they hit the lower bound, which in the US is zero. And we have found today that unfortunately, after bringing rates up to a measly 2.5%, they had to go and actually apologize, literally apologize for not seeing what they thought was a reasonable level. Oh my goodness, not even 2.5%, historically extremely low. And they have said that they expect that in 2023, they're going to be able to get interest rates back up to 2.5%. I mean, come on, come on, it's ridiculous. When the interest rates stay low for long enough, the policy can even become, check this out, this is his quote, counterproductive. In US, monetary stimulus has already pushed bond and stock prices to such high levels that future returns will necessarily be lower. And then he goes on. Now think about that. He is actually putting these two together. The stimulus here and stock prices. And there is, of course, a direct correlation between these two. You and I know that. Essentially, we look at what's happening with the S&P 500, and that could be basically mirrored to what we're looking at with the Federal Reserve's balance sheet, or more likely the global central bank balance sheet. They are completely intertwined. Sure, there are variances, as I say all the time, but that's what we know. And now we have a former Fed president saying the exact same thing. And in that, to me, is huge. I think it was just the previous video where I was talking about what's happening with the Bank of England and Australia, New Zealand, and so on. And I believe I suggested that they were going to pump in 100 billion into the economy, as they say, but actually it's not the economy, 100 billion. And now they've already gone with 150 billion. So they've accelerated that, pumped it up by an extra 50 billion. Why? Because of everything that's been happening, the shutdowns, the economy is weak, and so on. So they do this quantitative easing, which actually does not support the economy whatsoever, but it's a great excuse to take money from the middle class and give it to the elite. I put this video here because it's going to connect us in with the rest of the video. All-star investor Rich Bernstein sees a very bearish sign for the economy and corporate profits. Take a look. Narrow leadership is an end-of-cycle event, and you've heard me talk about a narrowing band. Of course, as time goes on, there becomes less names that are investable. Well, I don't want to buy that company. It hasn't really done well over the past year. Well, I don't want that one either because since the supposed recovery, it hasn't really performed too well. So what do I buy? Okay, well, we got Apple, we got Amazon, and we got Facebook, and we got so on. You know the way it works. This is what we are seeing, and that is unfortunate, as he says right here. You want it to be the exact opposite. Early cycles are dominated by broad market leadership, and that is very worrisome. That's what you see at the peak of any bubble. Now, it doesn't mean that it won't go higher and higher. Look at the ridiculous heights that we saw during the year 2000, which I'll show you more about that in just a second. But certainly, it can definitely go higher than anybody's prediction. And that leads me to this, smart money flow. Isn't it interesting that at the peak of the Dow Jones, as you saw what looks like at the beginning of September, and by the way, it's been fluctuating ever since, as you can see here, the smart money was actually leaving. The smart money was leaving while everybody was saying, pump your money in. Now that's the Dow Jones. You look at the NASDAQ, different story. But it's just interesting to see. Now, I want to show you what it looks like when we go back a bit further. And all I wanted to highlight here in this was simply that there's a very big difference in between what we see with the average retail investor and what we look at with the smart money. Take a look at what happened in the beginning of the year. That green line, again, that's the Dow Jones. And you know that once we got into, March timeframe, the market just completely, went over a cliff. But then you look at the smart money. The smart money from basically the beginning of the year started to decline. And that was basically suggesting that they're pulling out. They're already getting out. and then the market started to turn over. It's just interesting to see that pattern. Yes, we have that happening today. Nobody really knows, of course, that could turn around in a second. We could have a resurgence there. But it's just interesting to see this happening right before our very eyes and have a pattern that is just recent, and we should be at least taking this into account. Look at how fast these tech stocks have accelerated just over the past few days. You are seeing something that is truly historic right now. The speed at which these stocks are going up is unlike anything we've ever seen before. They're showing you fan mag stocks, but essentially, the handful of names: Facebook, Apple, Netflix, and so on. You look through the names, you see the same ones coming up all the time. What are the biggest hedge funds holding? What is the average retail investor holding? What are the ESG funds, which aren't even actually ESG funds? What are they holding? What are all of these ETFs made up of? They're made up of these small group of stocks, that narrowing band that makes it very dangerous anytime there's a downturn. The Buffett yardstick, market cap to GNP, is what they're showing here. And we are essentially just off the top of a historic high. Never seen anything like this before. This chart goes back to 1947. So you can see that historically how bad things are. And I say bad for a reason. It's worse than 99-2000. It's worse than the financial crisis. And it doesn't seem to be letting up anytime soon. The problem is when it comes down, it's going to hurt very hard. I will show you the chart in just a second, but this quote here from this book, The Great Crash 1929 by Galbraith, if you haven't read this yet, I highly recommend that you do. It was recommended to me, and it's actually a very small book, but it was fantastic. Fantastic. I really learned a lot from it. Anyway, even the most circumspect friend of the market would concede that the volume of brokers' loans, collateraled by the securities purchased on margin, is a good index of the volume of speculation. And there he says, if the level of margin debt is indicative of the volume of speculation, then we might infer that just as we are witnessing unprecedented valuations, those extreme prices have been driven by extreme greed, the likes of which we haven't seen in generations, if ever before. And this is the chart, the margin debt. It is truly historic, going way beyond what we have ever seen. And we're just supposed to turn a blind eye to it? Really? Is that what we're going to do? It is so hazardous to the actual financial system. And here we go again and again. Watch out. Really quick points I want to make. Bezos sells more than $3 billion worth of Amazon shares. In 2020, he has sold $10 billion so far. I think it's interesting. Normally, he would sell approximately $1 billion a year. That was very normal. He had, some personal issues. So, of course, you can see how he would want to accelerate some of the sales. But this is historic. Now, he's going to be putting into this foundation and, all these different funds and so on. That's what he's planning on doing. We'll see if we can, pick up any of that. But it's just interesting to see that as the stock price has moved up considerably, he's been selling off as any other executive would. I just think that it's interesting. I did see another statistic that you might be interested in that the first 15 years of Amazon, since it went public, he has sold a certain, I think it's something like 1/5 of his shares or 1/5 of the company's. Anyway, if he had never sold that, he would have been, if you can imagine this, it would be something like $320 billion worth of stock. And that just gives you an idea of how really excessive this company has been traveling over this period of years. It has grown tremendously. And judging by that, he would have had something like $500 billion. It's just mind-blowing to think about. Just like always, I do not believe what CNBC and Bloomberg and so on tell me. I always go direct to the source, and I like to begin with Open Insider. If you want to know how to get this detail, I have broken it down completely in my free e-course. You can go to the playlists on my channel. You'll see it for yourself. There's a video in there. But anyway, I just took a look at this, and you could see Bezos over the last 1 year in what he has done, and all the different sales. All the information is right here if you are interested. Just wanted to touch on the fact that what we are seeing in places like New York and San Francisco and Toronto, where more people are moving out of the big cities and going to the suburbs, this has created demand, of course, for the suburbs, not just with the real estate, but for businesses as well, and so on. I wanted to mention it's also for London too. So it's essentially everywhere. You're looking at big cities that are really changing rapidly over this year in 2020. So that could be something related to different businesses that you might be involved in, or it might be just an opportunity for the future. On that same note, what's the most productive workspace? Might be the pub. And then they essentially say that with more lockdowns coming, the pubs have to shut their doors and these people have to go back home. I just think it's really interesting to see the dynamics and how things have changed over the last little while. There's a lot to this, but I just wanted to bring up this simple point here. And that's it. I'm going to end the video there. If you found it informative, please hit that thumbs up button. When you do, you are supporting me. I want to thank you for that. If you are interested in selling stuff online, you just want to learn about e-commerce and you don't want to pay anything, check out my free e-course, theamazongps.com. If you want to learn about the financial system from top to bottom, A to Z, I've got everything you need to know in these 2 books. Check them out at the link in the description. If you want the audiobook instead, themoneygps.com. Wait, hold on. Don't go anywhere. Have you seen this video yet? There's so much data. You definitely want to check it out. Click it. I'll see you there.